Hey guys, so I want to go over the option chain and give you guys a Greeks lesson. I had a weekly session with someone today and we were talking about the Greeks, and I realized how many people don't fully understand what they mean and how they tie into your trades, how they tie into the value of the option, the premium, and a number of other things. And it's going to be super important that you understand what the Greeks are, how they're calculated, and how they can play a huge role in your overall trade, because ignoring them, you may be on the right side of the trade, but you may notice that your option may not be doing anything. And it could all come down to those Greeks. Now, there are two most important Greeks that we mostly pay attention to, but it's important that you understand how they all pretty much tie into each other. So what I'm going to do is I'm going to take you guys to TradingView and we're going to go over to the option chain so that we can look at all 5 Greeks, okay? You have the delta, you have the theta, you have the gamma, you have the vega, and you have the rho. And we're going to look at each one of them, what the numbers mean, and exactly how to calculate them. And there's also a way for you to calculate your potential profits ahead of time before you even get into a trade. This is going to be super important when you're kind of going into your trades with a goal. Will this strike price align with the goal that I have for this trade? Will I have to be in this trade all day? Will this thing give me, my potential goal or certain profits in the next hour or two? There's a lot here that you can kind of calculate just by looking at the Greeks, and I'm going to show you guys exactly what I mean by that. So the very first Greek we are going to look at is the delta. Now, the delta is one of those most important ones that I was speaking about. The delta lets you know how much your option is going to move in value per dollar that the stock moves, whether you are in calls or whether you are in puts. This is the Greek that actually allows you to potentially calculate ahead of time what your profits will be, what type of move would you need to catch in order to see certain goals for your trade. So if we come over here, right, I am currently on Carvana's option chain, okay? Their ticker is CVNA. Now, you notice these deltas here, right? There are a few cents. 54 cents, 53 cents, 51 cents, 50 cents. Now, you may be thinking, so I'm only going to get 50 cents for every dollar that it moves? No. What you're going to do is you're going to multiply your delta times 100. And the reason for that is because each option contract includes 100 shares. So you're going to multiply the same way you would multiply this your premium cost by 100. You'll do the same with the delta. So if you see here that it will cost you approximately $23.95 to get into this trade, that's not how much it's going to cost. You're going to multiply that times 100. And what that will be was $2,395 that you will pay to enter into this trade. You're simply multiplying it times 100 or by the number of contracts that you have. So if you got 1 contract, you're going to multiply that number by 100. You got 2, you multiply it times 200 and you go from there. Now back to the delta. If you want to make $200 on your trade, okay, and you say, okay, I need to make sure that this strike that I'm picking and has a delta that aligns with the goal. But not just that. You want to make sure that you're also trading a stock that has the ability to make a move big enough for you to see your goal. All right. Something like AMC moves a few cents on the day. You couldn't possibly make $200 on that with just 1 contract. Just to say you have only 1 contract, you will need a ton of contracts to be able to see a $200 goal, because it does not move in massive enough increments to even see that on a single day trade. It likely will take a little bit of time for that thing to move up unless you have a ton of contracts to multiply it that will allow you to see that kind of profit. Okay, so let's just say hypothetically you decided that you want to pick a $370 strike on Carvana. It has a 50-cent delta at this moment. You will need to catch what? A $4 move in order to see $200 in profit. Does Carvana make those type of moves? Yes. On average, Carvana does make a 4 or higher move for you to be able to see $200 in profit. Now, when I say potentially the profits, the delta value changes. It can increase and it can decrease. And we'll get to that. But we see here that this thing is sitting at 50 cents. So we'll multiply times 100 and we'll get $50 for every dollar move that we catch or convert. So once you see that $4 move, you will see your $200 in profit. You may see more, you may see a little bit less. It just all depends on how that stock moved and how long you had held it, either on that day or let's just say you held it over a couple of days. The other Greeks can kind of play a role in messing with your profits, and we'll talk about that in just a second. So before we get to that next one, all you are doing is looking at your delta. You're multiplying it times 100, and this number is letting you know how much you are going to see as this thing goes in your direction. Okay, and so the higher you go in the money on this option chain, the higher your delta gets. So if you're going all the way up, you got an 80-cent delta here. This letting you know for every $1 move, you're going to get $80 out of that trade. Okay, you catch a $2 move on this thing, you got $160 profit, and that's just with one contract. You add more contracts, you see more profit. You'll also notice something too. The option values are getting more and more expensive because you're going deeper in the money. You're getting even more valuable options, and it's going to cost you a lot more. So if you want an 85-cent on this delta here, you see that this particular strike price of $305 on Carvana is going to cost you about $6,000 to enter the trade. Okay, so the more valuable that particular strike is or that option, you will also see an increase in value on your delta. So the higher your delta, the quicker you'll see profits on that particular trade. Let's get into the second one, which is the gamma. Now the gamma ties directly into the delta. The gamma lets you know how much in value your delta is going to move in value up or down per dollar that the stock moves. So if you have a 50-cent delta and the gamma is just hypothetically 5 cents. So if that stock moves up by $1, your delta is going to increase by 5 cents. Now you have a 55-cent delta. This is why I say you potentially calculate your profits, because it could be more or it could be less. The gamma lets you know how much in value that thing is moving. So as long as the trade is going your way, your delta has the ability to increase more and more and more because that option is becoming more valuable. So therefore, you're seeing more in profits the higher this thing. That's the cool thing about the Greeks, okay? You can kind of calculate numbers ahead of time before you make a move on that trade. So if you got particular goals in mind, you got a particular time frame that you want to be in that trade in mind, you can kind of come to the option chain, crunch some numbers to see where you will potentially need to be and what strike you will potentially need to pick to meet your goal for your trade plan. All right, now let's get to the third one, which is the theta. Now, this one is the second most important Greek on the chain. Why? The theta is time decay, baby. When I say it is super, super important, you want to be sure that the time decay on this particular option aligns fully with what it is that you're trying to do in terms of how long you want to be in that trade. Your theta has the ability to eat away at your option value. Let's just say that you are $500 in profit. Okay, and the trade goes against you for a little bit. Let's just say it goes against you and now you're down 200 negative, but it goes back to the very same spot that you were originally up $500. But when you get there, it's only like, let's just say 450. You're like, wait, we was at this price. I was up $500 in profit. Why is I'm short $50 now? Simply because the theta eats away at the option value. So either the longer you're holding it, or a lot of times when it's going against you, the value of that option is decreasing heavily. And this here, if you notice, this thing has a negative 691. Now I will say this, if you're using another platform, some of these numbers might look slightly different than it does here on TradingView. Okay, now in this case here, this particular option expires on February 20th, okay? That's this Friday. So the further you go out on the option chain, your theta will decrease a bit, okay? Because now you're buying more time. Remember, this is a time decay group. So the further you go out on your expiration, you're basically saying, I'm buying more time. So my theta will decrease the further I go out. So for February 20th, you see these really high thetas. You are literally $6.99 compared to this 54 cents. You are going to see some major burn if this thing goes against you. But I also want you to understand something too. And the reason why I picked Carvana is because they have earnings coming up after the market closed today. And this is right now as I'm making this video. Because one of the things about earnings, when they're coming up, you'll notice things like the volatility is extremely high on the stock. So therefore, that theta 2 will also be high. And because this thing expires just this Friday coming up, the theta gets higher. If we really quickly go to, let's just say March 20th, which is about a month from now, and we go over and look at that theta, look what we're seeing now. This thing is much lower. This thing went from $6 to 64 cents, 63 cents. And also, this is way out from earnings. With earnings coming up, it really spikes a lot of these numbers that we're seeing on Carvana. And it was one of the reasons why I picked it, because of one of the Greeks that we're going to get into, for you to understand why that number is so high like that. Theta time decay. Pay attention to it, because it'll let you know that, hey, if my trades start going against me, that this is how much in value that this thing is going to potentially decrease, and how much it can eat away at my options value and what I could potentially take. And also, it can eat away at it so much that you may have been in profit, you stay too long, it goes against you, it goes back, and you're still in a negative. That is because you have allowed that theta to eat too much into your option value. So even if it goes back up, you're still potentially in a negative, or maybe you're breaking even, or you're like right at zero and you don't understand. It's the theta. Before we get into the Vega, yes, you do multiply that theta by 100, okay? So the delta and the theta are two that you will multiply times 100. Now, let's go back to February 20th, and we are going to look at our next Greek, which is the Vega. Now, this is the reason why I chose Carvana, with the fact that they have earnings coming up today after the market closes at the time that I'm making this video, okay? And so the reason I wanted to pick them is because when earnings is coming up, or some major event surrounding a particular company, the implied volatility is going to spike like crazy, because people are expecting a major price swing. And Carvana is one of those ones that has seen some really big price swings during their earnings, or I just say after their earnings. It may have went up, it may have went down, but that move was a very nice move. $30 on one, $60 on one, $100 before. Like, it has made some nice moves. And then when people are anticipating these type of moves, it will result in the premium price spiking, the implied volatility spiking, and the Vega spiking, okay? At this moment, the Vega is sitting at slight moderate right now. It's sitting at a 0.10. And so with it being at 0.10, that is basically saying that this thing here can definitely see some massive price swings, and people are anticipating that, and they're flooding in, getting their positions ready for the upcoming earnings. And when that demand is high like that, and people are buying up like crazy, the things that will spike will be that theta. It will definitely be high. And in this case, for the one that expires here on February 20th, that theta is sitting at $7 now. You notice that this thing has changed since we've been here. It can increase and decrease as well, okay? And so with that being so high like that, and the Vega sitting at that moderate on that volatility at that 0.10, is just letting you know that, hey, you might want to be sure that you are on the right side of the trade, that you are watching, and you look into why the Vega is so extensive like that. Why are the premiums so extensive like that? Simply because the earnings is coming up and people are expecting a massive move. And so it's spiking these numbers up on the Greek. Before we get into the last one, let me just say this. Anything over a point 20, 25, 30, 40, 50 on a Vega, you most definitely want to make sure that you know why that thing is high like that and what people are expecting, okay? Do a little bit of research. Check the news. Go looking into the stocks. Try to see what's resulting in this Vega being so high, because that can let you know that investors and traders alike are expecting a big move, and you want to make sure that you are on the right side of that trade when that move happens. The final thing is that the further you go out on the option chain, a lot of times you will see that the Vega has spiked a bit. So sometimes when you're going like 30 days, 60 days, 90 days and further out, you'll notice that the Vega has spiked higher. It going past 20. It's in those 30s, those 40s, those 50s, because likely you are expecting a big move, right? If you're going 30, 60, 90 days out, you're expecting a big move to be made from the moment you get in, 30 days out, 60 days out, 90 days out. So it will spike. But when you see these short dated ones, like one that expires in one day or one that expires in a few days or a week, you might want to kind of look into that, because you want to see what it is that people are anticipating for the IV to be so high that's also resulting in that Vega being pretty high as well. Let's look at the very last one, which is the roll. Okay, now the roll is, in my opinion, honestly, is one of the least important ones, because what the roll is just basically letting you know how much in value the option will change based on interest rates. So for every 1% that the interest rates increase or decrease, the roll will also move slightly and kind of make a move, but it will not impact it heavily unless something drastic happens with interest rates. We really don't have to look at the roll in terms of our trade, okay? But always just kind of look at your game plan and how things could be affected in the long run to know if you kind of need to pay attention to that. But the roll is just simply coming from interest rates, and it just kind of moves the value of your option based on the change of those interest rates. That's it. And you won't see the roll changing too often or too massively, I would say. So that one right there, that's just kind of the one that just sits off in the corner and just pop out every now and then when it needs to. So I have gone over the delta, the gamma, the theta, the vega, and the rho. Okay, these things are important, but that delta and that theta are going to be your best friends in your option trading. They're going to be the ones that's going to tell you that, hey, you need to make sure you're on the right side of the trade, or hey, this is how much you're going to get for every dollar the stock move. And if you don't plan on being in this trade all day, I would highly recommend you going and finding one that's a little bit higher, something that allows you to also hit your goals, okay? So when you are planning out your trades, whether a day trade, a swing trade, a leap, it doesn't matter. You want to be sure that the strike price that you are selecting aligns with your goal by looking at that delta, paying attention to that theta, okay? The theta will decrease some as you go further out on your expiration date, okay? And the higher you go in the money, your delta will increase. This allows you to see profits faster. It allows you to see more profit. I can have one particular strike, you can have another one. I could be seeing $200 in profit in that same exact trade you're in, but you may be seeing $2,000 in profit. So all come down to your delta, okay? And just think about it. If you're trying to catch $200 in profit on something and you got a 20-cent delta, you're going to have to catch a $10 move. Now ask yourself, does this stock make a $10 move for me to even be able to be aiming for $200? You want to be sure everything aligns with your goals. Okay, so I really, really hope that this video helped you get a better understanding of these Greeks that you see on the option chain. They are not to be ignored. I'm not really talking about the row, but hey, overall, the Greeks are not to be ignored. They're not something you just say, oh, okay, those are just numbers. I'm going to pick this blue strike here because it fits my account and I'm going to go on about my day. It may fit your account, but does it fit your game plan? So, and I will see you guys in the next one.